This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 449 was produced on October 10th, 2024. I'm Eric Townsend. Simplify Asset Management's convexity maven Harley Bassman returns as this week's feature interview guest, and our topic will be mortgage-backed securities and how to trade them.
And I'm Patrick Ceresna with the Macro Scoreboard week over week as of the close of Wednesday, October 9th, 2024. Just a heads up, I'm a bit congested today, but we're powering through with a great episode. The December S&P 500 futures up 141 basis points, trading at 58.41, breaking to a fresh new high. We'll take a closer look at that chart and the key technical levels to watch in the post-game segment. The U.S. dollar index up 125 basis points, trading at 102.87. The November WTI crude oil up 448 basis points, trading at 73.24. The short squeeze drove a rally above 78 before settling down. We'll take a look at that chart in the post-game, and Eric will have the EIA inventory data. The November RBOB gasoline up 352 basis points, trading to 206. The December gold down 161 basis points at 26.26. Correction back toward its moving averages underway. Copper down at 538 basis points, trading at 440. And uranium up 158 basis points, trading at 83.50. Continues to show signs of life. That U.S. 10-year Treasury yield up 27 basis points, trading at 407. The key news to watch this week is the Friday PPI inflation numbers. And next week, we have the U.S. retail sales and the ECB monetary policy statement. This week's featured interview guest is Simplify Asset Management's Harley Bassman. Harley and Eric discuss bonds, the current market environment, and more. Eric's interview with Harley Bassman is coming up as MacroVoices continues right here at MacroVoices.com.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Harley Bassman, convexity maven as he's known, and also with Simplify Asset Management, where he runs several ETFs. Harley prepared a slide deck to accompany today's interview. Registered users will find the download link in your Research Roundup email. If you don't have a Research Roundup email, just go to our homepage, MacroVoices.com. Look for the red button above Harley's picture that says, looking for the downloads. Harley, it's great to get you back on the show. Let's start with the big picture on mortgage-backed securities, because there's something I've never understood about them. We all know about these things. Everybody does. We're not talking about the esoteric securities that, only professionals can trade because they're not available on listed markets. We're talking about bonds here. Yet, for some reason, it seems to me like mortgage-backed securities are kind of a mystery world that are all these bonds get sucked up into CDOs for some reason and nobody trades the bonds directly. Am I missing something? What's going on here?
Well, there's a number of things. First off, thank you for having me back. It's a great compliment. You guys have the best financial show in the market, so it's great to be here. I think what's important to note is that when we say the word mortgages, people generally think, great financial crisis, subprime, default risk. That's fine. That is true, but that's not what I'm talking about here. When we say mortgage-backed securities, MBS, we're talking about basically the second largest asset class in the bond market, only behind U.S. Treasuries, and certainly more than corporate bonds and junk bonds. And these securities they would drive the whole mortgage process because most homes are purchased with loans that get put into mortgage-backed securities that are wrapped, guaranteed by Fannie, Freddie, or Ginnie. Civilians, what I call retail non-professionals, have no contact whatsoever with these bonds. Almost no one buys these securities. They're not available because they're just dirty little animals. You will buy them on ETFs or mutual funds or lots of ways to do it. But most people do not trade mortgage-backed securities for a variety of reasons we could talk about.
Harley, let's go ahead and dive into some of those reasons. Why is it? Obviously, this is a very important part of the market that a lot of people are exposed to in their retail accounts indirectly, but it's not something people trade directly. Help me, I still don't get it.
Okay, let's break it into two pieces. One is the process of making these bonds, and two is the value proposition of why you want to own them in some manner, fashion, or form. These mortgage bonds, what happens is the loans are created ordinarily as you go out and buy a house. The bank or entity that gets these mortgages, they put them all to Fannie and Freddie or Ginnie. They then look at the bonds, these loans, make sure they're kind of, high FICO, good numbers. They wrap them together and they put them into one giant, $1 billion pool. They stamp it and say this bonds are guaranteed by the U.S. government, more or less, and then they give them back to the market and they're then sold into the market. The thing is about these mortgage bonds, and if you own a house and you have a mortgage, you'll notice that when you pay your monthly check, so let's say you have a $500,000 loan, 6% coupon, you're paying $3,000 a month at a 6% loan. Of that, $2,500 is going into interest and $500 to principal. So what's happening is you're paying down your loan. It's amortizing over the course of 30 years. And the person who owns the mortgage-backed security has lent the money. He's getting this money back. Well, he has to go reinvest that principal basically every month, which is really a pain in the neck. On top of that, as the principal comes back to you, it's kind of a little mini trade. If you bought the mortgage bond at 95, when that $500 comes back to you, it comes back at par at 100. So you've made 5 points. And if you bought it at 105, you're losing 5 points, a little bit each time. That's taxable. So if you owned a regular mortgage bond, as I said, no one does. If you owned one, you have a massive, accounting and process problem. You have reinvestment risk and a tax problem. And that's why you rarely ever see these bonds trade to civilians. They trade within ETFs and mutual funds to absorb all that. It's also why when you look at a 30-year mortgage bond, it's never really a 30-year security, even if it never prepays, because you're getting that principal back over time and it's paying down because at the end of 30 years, the mortgage is gone. And so even in the worst case scenario, mortgage bonds are rarely more than a 12-year security because they're amortizing. So that's the process of the mortgage security. On the other side, what does a mortgage bond look like? A mortgage bond can be kind of modeled like a buy right, like you're buying a 10-year treasury at 100 and selling a call option struck at 105. That's kind of where the bond might start to prepay at. And so the value of the mortgage security really depends upon the value of that call option that's being sold, because the 10-year treasury part of it, the money you're getting back, is no different than a treasury that's amortizing over time. The uncertainty is not that principal, it's the call option. And so what drives that call option? It's interest rates and implied vol, like anything else where you're selling an option. And what I would propose right now is that mortgage-backed securities are probably the best way to invest risk-adjusted in the bond market. I would say they're the best thing out there right now.
Let's go a little bit deeper on why they're the best thing, and particularly mortgages. I mean, in general, you've been really hot on mortgages for the last couple of interviews we've done on MacroVoices. Give us the overview again of why mortgage-backed bonds instead of other bonds, and why this is and what the best ways are to acquire them, and what the best exposures are to hold in a retail account.
When you're buying a mortgage security, you kind of got to think, I'm selling a call option. I'm doing a buy right. When do I want to do a buy right? When I can sell that call option for a lot of money. What drives that call option is two things. One is where the interest rates are relative to the strike, so the market price versus the strike price. And the other is the implied vol. What's really strange and why mortgages tend to trade, let's call them 75 basis points over treasuries. That's the historical number. It's gone up and down. And you can see this on slide 13. And usually we might say that in that case, the treasury you're buying is at 100. You're selling a call option for 4 points. So you're knowing the package at 96. That's kind of how it works out to get a 75 basis point spread over treasuries. What happened in the last year and a half, 2 years, is that rates went up, but also the curve inverted. And when it did that, the way the option model works is it looks at where is the market, but not today's price, but the forward price. Okay, let's stop and do forward price. You've probably all heard of this. Forward price is not a prediction. It's not a prediction of where the market's going to be in the future. The forward price is basically the back end of a calculation. So, for example, grandma can buy a 1-year treasury at 3%, or she could buy a 2-year treasury at 4%. What should grandma do? Well, she's got to kind of figure out what's my break even. If she earns 3% for the first year, she's got to earn 5% that second year to earn 4% over the whole time. I'm getting rid of compounding and that kind of nonsense. That 5% is the 1-year rate, 1 year forward break even. It's simply a calculation of where I break even. If the curve's inverted, same process. If I have the 1-year rate at 4%, the 2-year rate at 3%, that kind of means the 1-year rate a year from now has to be 2 to break even. And that's where these weird things have happened in the market, is that you've seen these inversions. The inversion of the yield curve has made these forward rates hugely lower than today's rate. So looking at slides 10, 11, 12, all I'm doing there is saying, where would the 1-year rate, 1-year forward be? And right now, the market's moved a little bit from when I made these slides. It's about 75 basis points. On the 2-year, slide 11, you have to move 40 basis points. So the market is kind of saying, if you want to go and buy this longer securities, you need rates to come down a lot between now and then. And as I will suggest what we're going to talk about later on is why I don't think it's going to happen. But the market is pricing these things in. When you look at slide 12, that's the 10-year rate 3 years forward. And what's happening here is that forward 10-year rate, 3 years forward, is below the spot, the current rate, because of the inverted yield curve. When the option model looks at pricing this package, it looks not at the current 10-year rate, but the forward rate. Remember, we're looking at a 3-year option on a 10-year for our construction of a mortgage bond. That kind of means the model thinks the option's already in the money. So it prices the call option higher. And that's what's going on here is when we've had this massive curve inversion that drives the forward rate below the spot rate, the propeller head PhDs who model up this stuff, the numbers pop into the system and they come out saying this option has gone from 4 points to 8 points. And that's why mortgage bonds moved from 75 over to like 150, 160, 170 over. And the MOVE index, my favorite little buddy there on slide 7, which was cooking around at 50, 60, 70 for most of the GFC last decade, it popped as high as, 160, 170 recently. It's now around 125. Well, if I have this inverted yield curve with a very high volatility, I get a very big option value. And when you buy a mortgage bond, it's kind of like buying that bond at like 92, right? 100 for the bond, 8 points for the call. That's why mortgage bonds got so wide. What has happened in the last 2-3 months, vols have come down, the curve has become less inverted, and now that option's worth about 6 points. So maybe we're 125 over the curve now. There's more to go, guys, okay? It's going to go back on down because vol's going to come down and the curve's going to steepen. It's going to steepen slower than the market's pricing in, but it will steepen as the Fed pulls rates down. And you're going to see these mortgage bonds tighten a lot.
Let's expand on what you just said, Harley, because when you just said it's got a lot more to go, folks, it sounds to me like you're expressing a secular view toward higher inflation and or higher treasury rates. Is that the right conclusion? And if so, what's the rationale or justification for that conclusion?
I don't need the 10-year rate to move one lick. All I need is for the front end to come down relative to the longer rate, and that will go and drive it. I hate Slide 16, you need a few cocktails to look at this thing. But in a nutshell, what I've done here is said, and these are, once again, it's a little old, is taken this older yield curve from before the Fed cut. And then all I did was rotate the curve, the green column, to where we have a 2.5% front end and a 4% back end. And the option price goes from 6 points to 4 points, basically. It's just the bond math of how the yield curve rotating changes a longer dated option. And so, yeah, do I think back end rates are going up? Yeah, a little bit, sure. But I'm more convinced that you're just going to see a rotation around this 10-year point. And that's going to go make newly issued higher coupon mortgage bonds go up in price because the embedded option will come down. Now, this is very different than the mortgage index, which is what almost all of you own. Because if you don't own my ETF, you own someone else's, which is a mortgage index. The mortgage index has a very low coupon. That's slide 18, where you can see that almost 70% of all mortgage bonds have coupons from 2 to 3.5%. This is where public policy good, the Fed pulled rates down with QE, they bought mortgage securities in the market, and the whole universe of people refinanced their 30-year mortgages to much lower rates. That's a good thing. But the mortgage index is a very low coupon, long duration security. What you really want to own is the newly issued mortgage bonds with 5.5% coupons. That's where you have the biggest option. That's the near the money option. It's bonds trading near 100, and those bonds will be the most impacted because you're selling the meatiest option. So it'll be the biggest option that comes down in price. So far, we have the only ETF out there, or mutual fund for that matter, where you could buy only newly issued mortgage bonds in ETF form.
Harley, I know you've covered this in past interviews, but let's go a little deeper on why specifically newly issued bonds. What's wrong with a long time ago issued bond that just has a little bit of maturity left on it?
It's not a maturity issue. It's a coupon issue. If I could buy a Fannie 5.5% mortgage that was issued 5 years ago, I'm fine with that. What I care about is I don't want to own mortgage bonds with 3% coupons on them. So slide 17, taking the math from the prior slide, I was saying the 10-year rate was 4%, and therefore the embedded option is 6 points. If I go look at a Fannie 3, that's kind of like saying the option is 200 basis points out of the money. That option is only worth a point. That's a pretty bad bond to own. And I'll just tell you in general, when you do a buy right strategy, the idea is I think rates are going to be, or the underlying asset is going to be relatively contained within a small range, and I'm going to earn that money from selling the option. What you don't want to do is sell a deep out of the money option for pennies because you get very little money in with unlimited loss. And that's why it generally should never sell options for pennies. It's just a bad idea. And a Fannie 3 mortgage index kind of structure looks and barks like a deep out of the money call that you're selling for a point, which is just a lousy risk return.
Harley, let's put some context around this in terms of your view longer term about the fixed income outlook. What is the current outlook at Simplify in terms of, for a while it was secular inflation. I think you guys have kind of shifted more toward a range-bound outlook. What's the rationale there?
Well, first off, let's just be clear. This is my personal view. I'm not speaking for Simplify. Let's go and focus on why I like mortgage bonds, the underlying concept, and the risk process that drives me there. So, looking at slide 3. If you are in bond land, and I'm not talking equities or currencies or commodities, I'm talking in bond land, you have 3 buttons you could push: duration, credit, convexity. Duration is when you get it back, so a 2-year or 30-year. Credit's if you get it back, right, by default. Convexity is how you get it back. And if there was some AI supercomputer that was investing, it would look at all three of those and move money between those three vectors as each one offered a better or lesser opportunity. Well, duration. The curve is still inverted in LIBOR space and still pretty flat in cash space. You're not paid any money at all to take on more risk, to go from a 2-year that can move 1.8 points per point to a 3-year that can move 14, 15 points. You're not giving any extra income for taking on more risk. Credit. You have IG at about 53. You have junk bonds at 335. Those are both near the tighter end of their range. And so therefore, you don't have a whole lot of cushion if you're wrong on, this credit aspect. Convexity. The move is probably going to print, when this thing airs, around 125-ish, somewhere up there. That is very high relative to, the usual range it's been in. I mean, it's well over double what it was 3 years ago.
Harley, as the inventor of the MOVE Index, what's your opinion on the number that tells you, okay, if it gets this high, that means the Fed lost control of the bond market?
Well, the MOVE Index is actually a real number. It's not some kind of fake thing. You could take the MOVE, divide it by 16, which is the square of trading days in the year, and that tells you how much the market kind of thinks we're going to move every day. So 100 divided by 16 is getting close to 6. That's kind of what the market, a move of 100 means 6 basis points a day. That used to be kind of the average we'd see. We'd see the market go, the move between 80 and 120. That changed during the GFC if the Fed put their thumb on the scale. But before then, 80 to 120 was kind of the range. When you see that move getting up into 130, 140, you got a problem. Now, I'll tell you, when it gets to 130, 140, truth be told, you should be selling options. Those are very big numbers. Unfortunately, when the move's at 140, you're probably hiding under your desk crying for your mother. So it never really works like it should. And when the move gets, into 60, 70, you should be buying it. But right now, where implied vols are for interest rates, they're very high relative to how much the market's moving and what's in the future. I mean, right now, the move at 125, the actual realized move is about 75 right now. And it's the options, the implied vol is 125. That's a huge spread. Usually what you will see for most liquid instruments is implied vol for 1 month will be 8 to 12% over realized vol. If you look what's out there in general, the implied realized ratio, interest rate vol is the highest out there. So I want to go and push my chips to selling convexity risk, selling optionality on interest rates. And I think right now it's very propitious to do this for the reason that I think we're right. We're there. We're done. Bonds are cooked. Let's think of the big picture here.
Clarify what you mean by bonds are cooked. That means that bond rates have gone as low as they're able to go?
Yeah. I think they ain't going a whole lot lower and probably not a whole lot higher either. If the Fed wants a 2% inflation rate, fine. Let's say they get there in a couple of years. They're going to put their target rate at 250. Now, right now, they're being kind of conservative and they raised it to 290, but let's call it 250 is where they want to go to eventually. So a 50 basis point real rate. Historically, funds to twos is 0.5%, 50 basis points. That puts the 2-year at 3. And historically, twos to tens is 100. That's 4%. We're there. We're at 100 right now, 4% right now. I mean, and if you look at Fed funds to the 10-year, historically, it's been around that number there. So, I mean, I don't see how we're going to move a whole lot more. 350 to 450, fine. That's kind of the range we're going to be in. And if I could sell a big, meaty option with no credit risk, that's a pretty good deal to me. I mean, right now, mortgage bonds are trading 125 over treasuries. And I have IG credit trading 53. I'm almost 75 bips higher with no credit risk. Ding dong, wrong price. I mean, these mortgage bonds are way too cheap to credit. So that's why I like them. Now, if you think we're going to hard land or crash land tomorrow, like some people might say, then sure. Then the Fed funds rate won't be going, to 3 or 2.5. It'll be going to 1. And if it goes to 1, then everything else comes down with it. That's fine. But I'm not a believer in a hard or crash landing. I kind of think things are going to cook along just fine. Why do I think that? End of the day, what's the big idea? GDP is people times hours worked times productivity. That's it. And I think what we're having now is this concept of where we have people are working. We had immigration, which brought more people in. Now you can go and cry about whether you think about that's good or bad. I don't care about your politics on that. What I'll say is we've had an influx of people who are working, and they're going to go contribute to our GDP and contribute to the economy. I think the hard part here of GDP versus inflation versus unemployment is that we have this large number of people who've come into the country, and we kind of lost track of them. And that's why it's so hard to get these numbers to work. Why do I think inflation is going to stay elevated? So I'm in your camp. I'm with Jim Bianco's camp. I think that inflation will stay higher. It's not going back to 9%. Ain't going to 2 either. And I think that for 2 reasons. One reason really, just demographics. What are the 2 reasons going on here? Number 1, so looking at slide 2, the boomers are retiring faster than we expected. And they're retiring because we had COVID, which kind of pushed them out of their jobs, but also they made all the money. Okay, sorry, millennials, but we took all your money. We made it in stocks and bonds and houses and gold and art and jewelry and everything else. Okay, the Fed printed money, trying to create inflation. The idea was to create inflation for workers. It didn't work. They got asset inflation instead. I mean, they tried, but it didn't work. And now the boomers have all these assets. They can retire earlier and leave the workforce, right? And the boomers are the older, more experienced, more productive. So we're losing supply of goods and services. And on the other side, millennials, they get married later. First child in San Francisco, 32. First child in New York, 31. People get married 3, 4, 5, 7 years later than they did a generation or 2 before that. Okay? And so millennials, we saw 3, 4, 5 years ago, household formation was lagging behind trend. Well, trend was assuming the old style when you get married, when you have a kid. Household formation is swooping back up to the trend line because they're getting married later. And when you get married, you buy a house, you buy a car, you buy a baby carriage, you buy all this stuff. And there's this demand from the millennials running head on into a lack of supply from the boomers. I think that's going to go and keep inflation elevated more than we expect. And by the way, this is exactly what happened in the 70s and 80s. You did have the Johnson guns and butter concept, but more importantly, you had the boomers entering the labor force. And there are some great charts out there of labor force growth rate versus tenure rate that tracks the whole thing in the 70s and 80s. Was Volcker a hero? Yes, I suppose. We got really lucky that the boomers were kind of pushing out of the household formation, area. I mean, everything is really the boomers, okay? It's the pig and the python. Processing this giant boomer generation is where everything is. If you want to really follow economics, just follow the boomers. The millennials actually are bigger by number, but they're smaller by percent of population. And so that's why what you've seen here going on now is basically the boomers processing themselves. And eventually they're going to pass this wealth on to their kids, which I guess is a good thing, but that's going to take a little time to do. They're going to go spend it first on a Carnival cruise or going to Las Vegas or whatever before they give it to the kids.
Tell me a little bit more about credit, going back to page 3 in the context of mortgages. Because on one hand, I could make the argument that, look, if we're talking about an agency bond, a Ginnie Mae or a Freddie Mac, okay, it doesn't quite have that same guarantee of a treasury of full faith and backing of the U.S. government. But it's as close as they get. Those agency bonds are pretty darn secure in terms of the government assurances that are on them. So if I look at it in terms of what are they promising, it seems to me like it's an extremely safe, extremely creditworthy investment. But if I take another step back and think about the position the government's in, well, hang on a second. I mean, we know that the government is way over indebted already. We know that we've got what I think is kind of an overvaluation of housing prices. And we know that with increasing interest rates, there's going to be downward pressure on those housing prices in order to maintain the same level mortgage payment. So it seems to me like there's plenty of reasons to be kind of concerned structurally longer term about the security and the credit of mortgages. But then again, the government does backstop that with the assurances they provide in the agency bonds. So how strong is that backstop? Should we be betting on that?
Eric, usually our views of the world are pretty much aligned. In this case, sorry, man, just dead wrong.
Okay. Fixed income is not my trip, so I may be totally out to space. Educate me.
Fannie and Freddie are not going down. If you think they have a chance of going down, you should buy gold, guns, and cans of tuna, live in a cave. That is what life will be like if Fannie and Freddie go bankrupt. So it's not going to happen. Number two is to get a loan into a Fannie or Freddie security, it's got to be a lot better than they used to be. Do you know what subprime actually means? Fannie and Freddie, they only accept loans that are prime loans. They have FICO above 720. If you're a 719, that's a subprime bond. It used to be once upon a time that Wall Street would trade subprime bonds from 680 to 719. And that was a sweet spot, actually, to go trade these things. What went crazy in the GFC period, or pre-GFC, was we started trading bonds with 500 FICO scores. That's nutty. Those days are gone. The government put through with Dodd-Frank plenty of rules about know your customer and making sure people have high FICOs, that they have income available to go and pay their loans. The Fannie Freddie bonds, yes, the government is backstopping them, but those default rates are microscopic. Now, if you get into subprime loans, not agency loans, that's a different story entirely. And if you want to go there, be my guest. But what I'm talking about here is agency, Fannie, Freddie, Ginnie bonds. And I have very few worries about that. And on top of that, most of these loans are very low coupon loans with a heck of a lot of equity in them, because housing prices are up significantly from where they were 3-4 years ago. So the default rate of the loans Fannie and Freddie are guaranteeing is microscopic. So that's all. And people, the reason why people get hung up on this is because they never see real mortgage bonds available. The mortgage bonds you think you see are Fannie and Freddie callable debentures. Those are available to be purchased from your broker or Fidelity or some other system. You'll never see a mortgage bond on one of the investment systems. As I said, it's very rare for the public to trade them. Most mortgage trading happens what's called the TBA, to be announced market. 90% of all trading happens in that. And what a TBA is, it's a 1-month mortgage futures or forward. A forward or a future. A future is just a listed forward. What we do is almost everyone is trade the TBA market, and we every month we sell NOV, we sell AUK and buy NOV, we sell NOV and buy DEES, and we're rolling the bonds forward. So that's where most trading occurs. The other market, this 10%, is called the specified pool market. This is for the professionals. The professionals will go and they'll look and say, okay, I have a bond here that's mostly from Iowa, another bond that's mostly from California. They both have 5% coupons. What do I think about that? Well, you'll pay more for the Iowa bond because it'll be a slower prepayment, because people in Iowa don't change jobs as often as California. Also, the Iowa bonds, the loans, are smaller in size. So you might have on average $200,000 in Iowa, where it might be $500,000 in California. If it costs a fixed dollar amount, $3,000 to refinance your loan, $3,000 versus $500,000 is different than $3,000 versus a $200,000 loan. There are some rules out there with loans as small as $75,000. I mean, you love those loans if you're a specified pool buyer, because they're not going to prepay. It's just too expensive to do all the paperwork. And so when you buy, and that's, when you get deep dive into mortgages, but we're not talking about that here. We're talking about trading generic mortgage TBA bonds, which is where everything trades. That's the generic, construct. Same thing with oil or corn, where they have different gradings. Well, these are mortgage futures that trade.
Harley, let's come back to where the rubber meets the road, which is the time of issuance of the bond. I'm still struggling a little bit. Tell me again, in terms of portfolio construction, your strategy is not to buy mortgage-backed securities as they're issued and hold them to maturity. It's to roll them and do something else according to a strategy, which is what and for what reasons specifically?
Most mortgage strategies out there are matching the mortgage index. That mortgage index is going to have a very low coupon and a pretty long duration because the embedded option value is very small because the odds of a prepayment are pretty slim. A Fannie 3 has a 3% mortgage bond, has maybe a 3.75 loan inside of it. We would need rates to get down to, mortgage rates to get back to a 3% level to get someone to refinance and prepay those bonds. So that's why they're very long maturity, because it would take a massive rally to go and get those bonds to prepay. The bonds, I suppose, are fine. They're not going to default, but they're going to trade closer to like a 7-8 year duration security. And you have a much lower income and much lower yield of maturity on this thing. And you can see that on slide 19. What we've done is devise a strategy where you could buy basically near par mortgage bonds, newly issued current coupon mortgage bonds. So what we try to do is buy mortgage securities, and we target keeping the portfolio between 97 and 101. And we'll buy and sell securities to stay right in that sweet spot. That sweet spot is going to be the best risk return mortgage bonds. It'll be the mortgage bonds where the embedded option is the largest. And you can see from this table over here, you have a much higher distribution, a much higher yield of maturity, and a much shorter duration. The strategy is active per the SEC's rules, but it's really more rules driven. I want to go and try and keep these mortgage securities in that range of 75 to 101 because it'll give you a good profile. Now, if you think that rates are going to drop by 200 tomorrow, I suppose you'd rather have a longer duration instrument. But really, if you're that bullish, you shouldn't own any mortgage bonds. Mortgage bonds are callable. You've sold a call option above the level of the market. And if you think rates are going down a lot, you just want to buy treasuries, man. You want to buy something that's going to move. I don't think it's going to happen. And I think it's not going to happen because I think that we've finally found the high and the low. We know the Fed's told us where we're kind of going to go, where the target is. And I think we're going to be hovering around this 4%-ish level in the 10-year rate. And that means you're going to go and see the market not move all that much. We've clipped the tails off up and down for where rates can go. And therefore, selling volatility to the covered call strategy is what you want to go and do. There's other ways to do it. What I also like, similarly, is callable muni bonds. So muni bonds trading 99 to 100, somewhere in that area there, not at 101. Those too will have these big embedded options. And that big embedded option is going to be goosed up because interest rate implied volatility is very high. And the yield curve is still inverted. And that inversion makes the forward rate below the spot rate, which makes the model think the option's in the money. We know it's not in the money. We all know that. But the model doesn't care. The model looks at the forward price, and the inverted curve does that. Why does it matter about this? It matters because professional arbitrageurs can recreate these securities using derivatives. And if the price of these bonds gets too far away from its theoretical reconstruction, you could buy one, sell the other, and create an arbitrage opportunity. This, by the way, remember the book Liar's Poker? This is how these guys made all this money, is because what happened is that they started trading financial futures on the exchanges 80, 81, and options on these futures in 81, 82, 83. By the way, this is when I got into Wall Street, right when this happened. They made their money because once you had futures contracts trading on the exchange, there was a visible price of the forward. Because you're trading, whenever you buy a future, you're buying something that will settle tomorrow, next month, next year, and you're locking in that forward price. If that forward price versus the spot price, the current price, is different by more than the interest rate to finance owning it, that's free money. That's arbitrage. These guys figured out how to arbitrage these spot to forward before anyone else could. As a matter of fact, that's what I did at the beginning of my career, is I did this in mortgage securities, is I can arbitrage the current price to the forward price to where I could borrow money from Merrill Lynch. And that's why the arbitrageurs will keep prices kind of in line. They will go and buy and sell. Once again, buying gold in London, selling it in New York. If it gets wider than the price to insure it and ship it, someone's going to do that trade. Same thing in oil, right? You know this, Eric. That's why prices move around there relative to the price of how much storage is available and what it costs to go and put the oil in a ship to store it. It's all the same. When you look at your contango versus backwardation, doing the exact same math I am. You're doing it in oil, I'm doing it in interest rates.
The strategy that you're describing requires trading futures and or forwards, which are definitely institutional or professional instruments. Back in the day, the restrictions were so extreme that not only were those traded by professionals, but even if pros were doing the trading, if they were contained in a fund or an instrument, that couldn't be sold to the public for suitability reasons. They've changed those rules, and I believe it's that change in the rules that really opened the door to you launching the ETF that trades this fairly complex strategy that we've been talking about today. Is that right? And what's the rule change? What else does it affect? What's going on here? How come the rules changed?
Ding, ding, ding. Right answer. That's it. I mean, I was retired.
Okay, I made up for earlier when I got the credit question wrong.
I was retired, man. I came out of retirement to work for Simplify because what happened was 4, 5, 6 years ago, there was a rule change to the SEC that allowed you to put derivatives, futures, options, etc., into ETFs. And I'm a derivatives guy, and that's what we did. So our first trade was my big interest rate hedge, which we brought to market a few years ago, and it was up like, 91% a couple of years ago. It was the biggest moving ETF in the market, where we put a 7-year put option, interest rate put option into an ETF. This is the same idea. As a matter of fact, we are really, PIMCO Redux. Most people don't know this, but what PIMCO did, what Bill Gross did in the 80s, is he was the first person to put derivatives into a 40 Act mutual fund. And no one else did that. And that gave him a huge advantage because you could do a lot of interesting stuff with derivatives. It's just one more tool to play with. Most people had 3 toys. He had 5 toys. So he could do more stuff. What we're doing is the same thing. We're the first guys really to go and put derivatives into ETFs, which allows us to go and we could do fun, clever ideas, but we could also do just bread and butter, better beta. This strategy here is just bread and butter, better beta. Better beta. You saw all the big bond kings, 6 months ago talk about mortgages as being the best bonds on the planet when they were trading like 150, 160, 170 over treasuries. What was strange is that what they meant was newly issued mortgage bonds. They did not mean the mortgage index, which struck me as strange that someone else did not bring my strategy first. In fact, truth be told, I'm still stunned I've not been copied because this strategy is just so obvious. The bonds you want to own in mortgage land are the newly issued higher coupon mortgage bonds, not the legacy older index bonds. This is the meaty stuff you want to own, and no one else is doing it. We basically do the reinvestment for you. We do everything else inside this structure of rolling these mortgage forwards every month, and basically all the principal that might be returned, keep it in the fund via the roll process, and it never gets returned to you unless you want to sell.
Listeners, please understand for compliance reasons that Harley cannot be the one to tell you that the ticker for his ETF is MTBA, Mike Tango Bravo Alpha. Harley, I can't thank you enough for a terrific interview. Really look forward to getting you back on the show for an update in a few months. Meanwhile, please tell us where our listeners can contact you or follow your work.
I know this has been a kind of a heavy lift over here, but you can go to my website, convexitymaven.com, where I have my archive. I also have a section called Maven's Classroom, and there I have a selection of commentaries that are kind of general as opposed to trade focused. I publish every 4 to 8 weeks, depending on what kind of mood I'm in. Send me an email, and I will add you to my list. It is free. And I also do a song of the month, which seems to get more interest than my commentaries on mortgages, but whatever, I got to live with that.
Patrick Ceresna and I will be back as Macro Voices continues right here at macrovoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Eric, great interview with Harley. Now let's get to that chart deck. Listeners, you're going to find the download link for the Postgame chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means you have not yet registered at MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Harley's picture saying, looking for the downloads. Eric, let's cover crude oil starting with the EIA inventory.
EIA printed a build of 5.8 million barrels. Great big build, but the drawdowns on finished products more than made up for it, with gasoline drawing down 6.3 million barrels and distillates drawing down another 3.1 million barrels for a net petroleum drawdown of 3.6 million barrels. Cushing, Oklahoma, building 1.2 million barrels. The $6 correction of the last 2 days is exactly why I'm not chasing this market. There's no way that I want to be short this market. I think the geopolitical risks are extremely high to the upside, but I don't dare go long in size because I think we need a better setup, and there's plenty of possibility to take a huge loss in that trade if we go the other direction down before we go up in energy prices.
Well, Eric, we got a short squeeze on the upside, and obviously it's now mean reverting, but I think it is actually a trend shifter. I'm generally biased to the upside, and I wouldn't be shocked if there was another squeeze to the upside toward $80. I think it's purely liquidity driven, and I wouldn't want to anchor it off of fundamentals, which is essentially expect a lot of volatility as a lot of traders are offside on this. So it's just going to whip the market in both directions. Generally, I think, though, that we could easily see oil back up into the 80 handle, at least for a short period of time. Now, Eric, let's talk equities. We're recording this before we see the CPI and PPI numbers, but the market has broken slightly higher. What are you thinking?
Patrick, I'm not surprised to see the melt-up continuing here. And, call me a conspiracy theorist if you want, but I think it's as simple as they're pumping the markets into the election. Plenty of good reasons to think about hedging here, but again, I think these markets are likely to continue to melt up into the coming election. Now, don't forget, a lot can happen in these last few weeks before the election. Another attempt on President Trump's life is entirely possible. I would say it's probably more likely than not, and needless to say, that could introduce more uncertainty, and who knows which way this thing could go. But I think barring major news events, the most likely outcome here is that the market continues to melt up into the election.
Eric, while the melt-up does continue, there are a number of target zones up above around 5,900 that are on a way of being completed. I think that even if the market does muster up a reaction to the upside first, I think that a correction at some point is underway. That doesn't mean it has to be a drastic one or a deep one, but we are getting into earnings season, and there could be a number of variables that just allow the market to go through some degree of a consolidation. Let's move on to the dollar, which continues to bounce. What are your thoughts?
Just as I predicted last week, a counter-trend rally is on to the upside in the dollar. This week's close above 102 on the Dixie is a sign that it probably has farther to go, with the next obvious resistance level just above 103, right around 103.20 or so.
Yeah, Eric, I'm trying to keep it really simple on the dollar. It was so oversold. A bounce back to 103 where the fib zone is, and a bounce on the US dollar yen back to 150 was a very typical retracement or reaction from a very oversold dollar. But I think that a lot is going to now hinge on the outcome of the elections. And I think that the dollar is probably going to settle in. And the next major move in the dollar off of these levels is probably going to have the tailwind of an outcome of the election. All right, Eric, let's talk gold.
Patrick, I'm absolutely delighted by the pause in the gold rally. We were looking 2 weeks ago at an extreme overbought situation. We've moved from extreme overbought to just moderately oversold. The slow stochastics are still pointing down, so the correction is probably not over quite yet, but we're nearing the end of it, and we haven't lost that much ground on price. That means that the stage is set, once we do bottom out here on this correction, to move to new highs, maybe getting above 2,800 by election time. Now, of course, as I mentioned earlier, a lot can happen in these last few weeks between now and the election, and needless to say, there's plenty of room to go in either direction. But barring unforeseen circumstances, I do not think that this rally is over by any stretch. I think we're in a short-term consolidation to just work off that overbought condition so we can have one last big rally into the election. At least that's my base case.
Well, this retracement in gold is now coming back to the moving averages. The 2600 area was an area that I thought had every opportunity to be tested. There's no reason not to assume that it's a buy on dip area. And so as this pullback is coming in here, we're tactically looking at putting on new longer trades for a retest of the highs. All right, Eric, let's touch on uranium.
Spot uranium prices finally seem to have bottomed, and the price discount in spot has vanished. So it feels like the market is now maybe just having a little bit of a pullback from that first round of exuberance and excitement that the bottom is finally in. And that means that we may be close to filling in some of those gaps that were left in the charts below the current price level. My resting limit orders await those gaps just in case they happen to get filled in coming days, which I think there's a good chance that they will. So I'm reasonably confident that the bottom is in for uranium miners. Now, of course, you can't promise anything in this business. Anything's possible with news events, and a broad equity market sell-off would certainly do the trick in terms of taking the wind out of the sails of this uranium market. But I think there's a good chance to fill those gaps before we move much higher in price, and I'm going to be using that opportunity to add even more to my already overweight uranium longs.
Well, Eric, it's nice to see uranium come back to life after spending virtually the entire year in a deep consolidation. The bigger question here is, can we see the bulls keep building on this recent momentum shift? Will we see accumulation on dips and all the other types of patterns to suggest that we might have another big upside going into 2025. At this stage, this correction has been so long and so deep that there's no reason not to suspect that there's a new bull market potentially starting here.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. Patrick, tell them what they can expect to find in this week's Research Roundup.
Well, in this Research Roundup, you're going to find the transcript for today's interview, as well as a chart book we just discussed here in the postgame, including a number of links to articles that we found interesting. You're going to find this and so much more in this week's Research Roundup. So that does it for this week's episode. We appreciate the feedback and support we get from our listeners, and we're always looking for suggestions on how we can make the program even better. Now, for those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account at MacroVoices for all the most recent updates and releases, and also follow Eric on Twitter at Eric S. Townsend. That's Eric spelled with a K. And you can also follow me at Patrick Ceresna. On behalf of Eric Townsend and myself, thank you for listening, and we'll see you all next week.
That concludes this edition of MacroVoices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. MacroVoices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to MacroVoices on iTunes to have MacroVoices automatically delivered to your mobile device each week, free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. MacroVoices is presented for informational and entertainment purposes only. The information presented on MacroVoices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on MacroVoices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. MacroVoices, its producers, sponsors, and hosts Eric Townsend and Patrick Ceresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on MacroVoices. MacroVoices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.